Hey everyone, ready for another deep dive. Today we're tackling HDFC Bank's Q2 FY25 performance. We'll break down what's hot, what's not, and what it all means for this banking giant. Oh, and before we jump in, if you find this deep dive helpful, please like and subscribe to this channel for more. Now, to help us decode all things HDFC, we have a true financial whiz with us.
Happy to be here, ready to unpack these financials.
Okay, so HDFC Bank, it's kind of a big deal in India, right?
Absolutely. I mean, they're everywhere. They're a massive player in Indian finance, offering everything. Basic savings accounts, loans, investment products, you name it.
So when HDFC does well, it's a good sign for the whole Indian economy, right?
Yeah, pretty much. You can kind of think of them as a bellwether for the entire financial sector. If HDFC's struggling, it could mean the whole market's in trouble.
Got it. So let's get into their Q2 report. What's the good news? Any big wins for HDFC?
Well, their revenue growth was pretty impressive, up 10.7% year on year.
Oh, wow. That's a nice jump. And is that better or worse than the overall industry?
Definitely better. The industry average is closer to 7% growth, so they're outperforming there.
Okay, so revenue's up. But what about their actual profits? Are they making money?
Yeah, their operating profit is strong, and their asset quality, which is really important for banks, that's holding steady, which is good. But what really caught my attention was their liquidity coverage ratio. It's at 128%.
128%. Now, I have to admit, I don't always speak finance. What does that number actually tell us? Why should we care?
Well, it basically tells you how well a bank can handle a sudden financial shock. Imagine a ton of people try to withdraw their money all at once, or there's a big market crash. A high liquidity ratio means they can weather the storm, no problem, and 128% is way above what they're required to have.
So basically, HDFC is a nice big safety net.
Exactly. They're in a very strong position, financially speaking.
That's good to hear, especially with all the uncertainty in the global economy these days. I also noticed that they're really focused on keeping a healthy loan-to-deposit ratio.
Right, yeah, that's a big one.
Can you remind me again why that ratio matters so much?
Sure, it basically shows how much of a bank's lending is funded by customer deposits versus borrowed money. And a lower ratio means they're relying more on deposits, which is generally considered safer and more sustainable.
So it's like they're not borrowing a ton of money to make loans.
Right. And HDFC, their current ratio is around 16%, but they're actually aiming to get it down even further to the high 80s in the next few years.
Wow, okay. So it sounds like HDFC is doing pretty well, all things considered.
Yeah, they're in a good spot.
But I'm sure even a giant like HDFC faces some challenges. What are some of the headwinds they're dealing with right now?
Well, one thing is that credit growth is slowing down a bit. It's not a huge drop, but it's something they're watching closely. And then there's the issue of rising deposit rates.
Yes. That's been in the news a lot lately. Can you explain why that's a challenge for banks?
Well, it means they have to pay more to attract deposits from customers, and that can cut into their profits.
Got it. So they're facing slower credit growth and higher costs. Not exactly ideal.
Right. Plus, there are always those ever-changing regulations to contend with.
The joys of the financial industry. So they've got some challenges to navigate, that's for sure. But are they just trying to ride out the storm, or are they making moves to adapt?
Welcome back, everyone. Last time we left off with HDFC facing a few headwinds. But before we get too deep into those, let's take a closer look at their actual numbers. What stood out to you when you were going through their financials?
Well, for starters, their net revenues came in at a very respectable INR 36,998 crore.
Okay, and that's how does that compare to last year?
It's a 10.7% jump year on year, so pretty solid growth. And their net interest income, that's basically the core of their business, how much they made from lending, that saw an 11.4% increase, reaching INR 28,148 crore.
Okay, those are some pretty healthy numbers, but I think I remember reading something about their profit growth not being quite as impressive. Am I remembering that right? You are. Their profit after tax, or PT, only grew by 5.3% to reach INR 16,804 crore. But there's kind of a catch there, something investors need to keep in mind.
Okay, now I'm really curious. What's the catch?
Well, if you adjust for certain one-off items like bond gains and tax adjustments, the profit growth actually looks a lot better, closer to 17%.
Oh, interesting. So it's kind of misleading to just look at the headline number. Can you walk us through why those adjustments matter so much?
Sure. So bond gains and tax adjustments, those can be temporary blips, They can skew the picture of the bank's underlying performance. So when you adjust for those, you get a clearer sense of how the bank is really doing operationally.
Okay, so the 5.3% might seem a little underwhelming at first, But the adjusted 17% tells a different story.
Exactly. It suggests their core operations are strong. They're making money.
So we've talked about revenue, profits, and some of those broader challenges. But let's zoom in a bit. What are they doing operationally to deal with this tricky market? What's their game plan?
Well, one thing they're doing is really actively managing their loan book. Like a captain navigating a ship through rough waters, they're being very selective about where they lend money, especially in areas like unsecured retail loans and large corporate loans.
So basically being more cautious in riskier areas, not just chasing growth for the sake of it.
Exactly. It's all about that risk-reward balance. They want to make sure they're growing sustainably and profitably.
Makes sense. And what about on the flip side? Attracting deposits. How's that going?
Well, it looks like their deposit mobilization efforts are working. Their average deposits are up about 15% year on year.
Wow, that's a big jump. So they're managing to keep that loan to deposit ratio healthy, which we talked about earlier. That's good news for their long-term stability, right?
Right. It all ties together. Strong foundation, strong growth. But of course, we can't just focus on HDFC in isolation. We have to look at the bigger picture, the whole market, the industry trends, all of that. What are some of the factors that could affect their performance moving forward?
Well, one thing to keep in mind is the overall liquidity in the market. We've seen some improvements, but deposit rates are still pretty high, and that can put pressure on HDFC's net interest margins, which you might recall are currently at 3.46%.
Yeah, so they're making money, but it's costing them more to do business. Not exactly a recipe for soaring profits. Anything else on the horizon that investors should be aware of?
Well, HDFC themselves have said they expect credit growth to moderate a bit in the coming quarters, converging with deposit growth rates. So they're being realistic about the economic climate. They know loan demand might soften.
So no rose-colored glasses there, they're being pragmatic. But big picture, are they feeling optimistic or pessimistic about the future? It's hard to say for sure. They didn't give any specific guidance, hard numbers. But the overall tone during their earnings call was, I'd say, cautiously optimistic. They kept emphasizing their strengths, their brand, their diverse portfolio, their digital investments. Like, they're confident they can weather any storm and come out on top.
Okay, so they're not panicking.
Nope. It's more like they're acknowledging the challenges, but they're also highlighting their strengths.
It sounds like they're playing it smart. Well, we've covered a lot of ground here. Financials, strategy, market trends, the whole 9 yards. But hold on tight, because we're not done yet. When we come back, we'll wrap it all up and distill the key takeaways for all you investors out there. And we're back for the final leg of our deep dive into HDFC Bank. We've looked at their performance, their strategy, the whole market landscape. Now it's time to answer the big question, the one we all want to know.
What does it all mean for investors?
Exactly. Is HDFC a buy, a hold, or a sell?
Well, I can't give financial advice. But I can help you connect the dots, give you the info you need to make your own informed decision.
All right, so let's start with the basics. How would you rate HDFC's overall performance this quarter? Good? Bad? Somewhere in between?
I'd say it's a pretty solid yellow light, maybe even leaning a little green. Revenues are up, operating profit is good, asset quality is stable, and their liquidity is fantastic. Those are all positives.
Okay, that's encouraging. What else should investors be excited about? What were the highlights for you?
Well, those strategic initiatives we talked about, those are definitely worth paying attention to. That branch expansion, especially pushing into those semi-urban and rural areas, that's a smart move.
Yeah, it's like they're tapping into a whole new market. Lots of potential for growth there. And how about their digital investments? How are those fitting into their overall strategy?
Those are huge. I mean, the whole financial landscape is shifting, right? Everything's digital now. And HDFC is not just trying to keep up, they're trying to lead the way.
So they're not just adapting, they're innovating.
Right. They're enhancing the customer experience, streamlining their operations, and they might even find some new revenue streams through their digital platforms. It's a smart move.
Okay, so they're playing the long game.
Yeah.
But let's be real, it's not all sunshine and rainbows, right? There are some challenges. What are the potential risks that investors should be aware of?
Well, that moderating credit growth is something to keep an eye on. Even though they're being careful about who they lend to, it could still affect their interest income, their loan portfolio. It's a tough balance.
And those high deposit rates, those aren't going away anytime soon, I bet.
Probably not in the near future. And those can really squeeze profit margins. It's a constant struggle for banks, attracting deposits while also keeping costs down.
And of course, we can't forget about regulations. Always changing, always something new to adapt to. That can throw a wrench in the best laid plans.
Definitely. The regulatory landscape is always shifting. HDFC needs to stay agile.
Okay, so we've got the good, the bad, and the maybe. Taking it all together, what's your final verdict on HDFC Bank? If it were your money, would you invest?
Well, I can't tell you what to do with your money, but I will say this. HDFC is still a very strong contender, especially if you believe in India's long-term economic growth. They've got a great track record, a solid strategy, and they're willing to adapt.
So, not without risks, but overall a pretty good bet.
Yeah, I'd say so. But as always, do your research, know your risk tolerance, all that good stuff. But yeah, HDFC is definitely a company worth keeping an eye on.
Great advice. And for those of you who want to dig even deeper, check out the full earnings call transcript, their financial reports, all that fun stuff. It's all publicly available.
Exactly. Don't just take our word for it. Do your own homework. The more you know, the better.
Couldn't agree more. And hey, before we go, don't forget to hit that like button and subscribe to this channel for more deep dives just like this one.
Until next time.
That's all for today. We've covered a lot, but hopefully you've come away with a clearer picture of HDFC Bank, where they stand, and what the future might hold. Thanks for joining us on this deep dive, and we'll see you next time.